Matt, if you can share as a brief insight into you, please.
Yeah, Alex, good to see you. Thanks for having me on the show. My name's Matt Sharrers. I'm now the managing partner of ETJ Advisory, which is a advisory business that I started a few years ago. I specialize in coaching CEOs and advising boards, private equity-backed companies, to ensure they hit their mark. Previous to that, I was the first employee and CEO of SBI, which is a private equity backed. We sold it a couple of times. Growth advisory firm. It's been around about, I guess, 17, 18 years now. And prior to that, I was a sales leader in a large publicly traded business services company and played a little professional hockey out of school. So I've kind of had three distinct careers, and I guess I'm starting number four.
Appreciate the insight. So what's one mistake that you see either P firms or portfolio companies making, and what actions would you suggest to correct them?
You only want me to give you one?
Well, there's probably a ton, but we'll focus on one to begin with.
No, listen, I think, as it comes to, why I wrote the book, part of it was to really try to help not only the private equity firms that are investing, but most importantly, the founders and the second CEOs that are succeeding them understand how to navigate that tightrope, because succession is always tricky in the CEO seat, but taking over for a founder CEO has a unique set of challenges. And so I think what I've seen and what I observed, which was the impetus to write the book, and also I lived it, taking over for Greg Alexander, who was my partner and was our first CEO, is you underestimate some of the cultural impact of people who have come to work for a founder and a founder's vision. And even if you are there along the way, which I was, or you're coming in from the outside, it's figuring out how to maintain all of that good, all of that vision, and also recognize what your job to be done is as the quote scaler, that second CEO, but also having good alignment. If you do have a private equity sponsor, on how are we going to create value and what time frame are we going to do that over? Because oftentimes you see everybody aligned on the right things, but what you don't see, Alex, is the time frame and the investment required to actually pull those things off.
Okay, so mention your book there. We'll kick off with that. Why the title of the book, The Second CEO? I think you might briefly give us an insight into it there, but just for clarification.
Yeah, I mean, short answer, this was the book I was looking for in 2016 when my partner Greg and the two other co-founders, Aaron and Mike, when we first had a discussion about me taking over as CEO and us taking the business out for a transaction in 2017, it was like, how do I do this? And going through what I went through, well, we got to a great place and were able to transact nicely a couple of times. I also recognize there were a bunch of mistakes I made. So if I could codify a methodology and an operating manual to help second CEOs not only grab the baton, but also take the company to the next level and the importance of what they do in their role, that would be a mission worth going on. So that's why I wrote the book.
So your perspective. So a lot of when first-time private equity comes in, takes over from the owner, from the founder, whoever it is that's transitioning out, and you're a new chief exec coming in, a lot of the plays that we see there are huge cultural change and moving from being what usually described as a sleepy type business into a fast-paced type organization that private equity would like. Even if that business has gone through huge scaling growth, private equity still want to see more and get their pound of flesh. What advice are you sharing based on your experiences and coaching with various different people in that transition with the chief execs to help them drive cultural change?
Yeah. So I guess the first one is to really define what culture means. Alex, you talk to a lot of people and you say, hey, what makes it different to work at Acme? And people will say, that's our culture. You say, tell me more. The answer to tell me more is very different from 15 people. If you say, tell me more, versus being able to truly describe one's culture, that it's got a set of things, right, that you won't find somewhere else. And so in the book, I talk about this ability. When I was leading SBI, we would say, hey, if someone said, tell me about your culture, we would say, hey, we're purpose-driven, vision-focused, and values-based, and then describe what each component of that was. What was our purpose? What is the vision? And then what are the values, which defines how you behave? And what that allowed us to do was have consistency across the organization, but also make culture an active mechanism for hiring, make it an active mechanism for onboarding, performance reviews, and exiting people from the firm, because that became the cornerstone upon which you did that. So I think understanding and baselining culture is critical. And then the meat of the book after that, we talk a lot about just the operating model of a CEO in a private equity backed environment. How do you make the strategy decisions of where to play and how to win? How do you think about the core processes that run the business? How do you go from the team to your team? And then how do you build a board of directors that's the right set of advisors to guide you and shepherd you along the way as the second CEO?
So if you've come in, there's defining that culture, but a lot of firms' cultures at that level aren't what the private equity firm would want, and probably the CEO. So how do you go about driving that kind of cultural change to go from the impetus of whatever came before to the new impetus?
Yeah. Well, I mean, first off, don't listen to the private equity firm relative to how to set culture, because they'll tell you they're investors, they're not operators. A big mistake I see is first-time CEOs, or even first-time CEOs dealing with a private equity firm. They become deferential, and they're leaning on these deal partners who will tell you they're great investors. They did an undergrad at Yale, an MBA at Harvard. They spent 2 years in banking. They climbed the ladder. Everybody's resume looks the same, and they're super, super bright guys, and they would get a way higher score on an SAT than I would. However, I'd bet on you, Alex, or me, when it comes to operating a business filled with human beings and not filled with Excel spreadsheets and a deal model that goes to investment committee. And many of my buddies that lead their own private equity firms, and some very notable ones, will tell you that they don't want to operate businesses, and they're self-aware enough to know that. So a common mistake I see is being too deferential, number one. Number two, not sort of reorienting with the current leadership team and putting a stake in the ground 5 years out, what I call future back planning, to go, what do we want to look like in 5 years? What are the descriptors? When we wake up 20 quarters from now, what are we doing? What do people say? What do our clients say about us? And then how do our best people behave? And when you do that, you kind of think about a Venn diagram coming out of that, you'll start to define what you want to look like. And from that comes a refined purpose, comes a vision you can get behind, and then to say, well, how do we want our people to behave, which is where core values come from.
When you're doing these conversations, Patrick Lencioni talks about in his books about driving that culture and creating that level of change. How is this done as a senior management team to kind of define things? Do you bring people in from, whether it be the shop floor of a manufacturing plant or the coders, developers, whoever's in a software business to whatever industry it is? How do these things begin to build to get the buy-in on the creation side, rather than going, we've decided we want you to all be like this?
Yep. So you start with the C team, the executive team, top down, but having culture champions in the business at different levels who can tell you if your ideas are right, who can help shape those values and be the change agents. A metaphor I use in the book that came from the gentleman who took over SBI for me, Mike Hoffman, is you got to go to the bottom of the pool and then come all the way back up. And Mike's right when it comes to that. So that's how you do it. And then number two is, what are the cultural norms that you as a CEO develop that says the culture is alive? So how do you communicate? Do you talk about the values weekly? Do you have them on display? Do people feel them? Or is it just a bunch of what posted on the wall and people go, yeah, it says that, but we don't behave that way?
Yeah, makes sense. So first, books centered around first-time CEOs. So I want to focus that around it. What are the other common barriers that you find private equity-backed chief executives are facing in that first-time private equity-backed business?
Yeah. trying to make sense of an underwriting base case that doesn't necessarily reflect the reality of running a business. So for those not familiar or steeped in private equity businesses, a private equity firm will do a deal model and they will go to investment committee and they will have what they call a base case that says, if we do the following things at this rate of growth, blah, 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 here's our outcome, plus or minus 5 years from now. And yes, there is diligence done in building that. And Alex, you know this because you live in that world. However, making sure that you really understand what it takes for the industrial logic to bring that to bear. Hey, we're going to open up a new market. We're going to scale this product through this channel. The level of effort it takes to put that change in place is often something that the business, if they're a first-time private equity-backed business, doesn't know how to run at that pace. They've been scaling and growing, but they don't know how to do it in a manner that a sophisticated investor who's got other portfolio companies has seen. So you sort of need in that first year to really understand, hey, how are we going to work together? Right. So I think that's the first one. And then the second one is, how is the private equity firm going to be a supporter and helpful, but not try to run the business and not overanalyzing too much data and not being in the way of the team, but giving the CEO and the CFO and the rest of the C team enough space to do their job.
So if we're looking at a first time private equity backed businesses, they've come across some of the barriers that you've got. What are similar with the cultural type of question of driving and creating change? It seems like there's a relationship, you know, your kind of mantra is that the chief exec comes in and drives that. I completely agree with that. You know, you've got to lean on the private equity and manage that relationship well. How are you, what advice are you sharing with those chief executives to be managing that relationship with the private equity firm when they might be saying one thing, the business might be demonstrating another, you know, because the difference between the due diligence and actually what's going on could sometimes paint a different picture. How are you advising your chief execs to best manage that relationship with private equity?
That you have an information advantage because you're running the business every single day. So don't be deferential to somebody that has an opinion. Be open to the opinion, right? No different than when a customer tells you, hey, I think you should change the way we do that. You do this for us. That's like, hey, appreciate the feedback. Thank you. You don't automatically go and change how you do business based on one customer. It's one opinion. And especially, Alex, if you have a private equity firm who doesn't necessarily have vertical expertise and has pattern recognition in your space. So they invested more because they like the thesis, they like the management team. But if they haven't done 15 other companies that look like yours in the same industry, they're going to be looking for you to be the expert, right? Versus somebody who's like, hey, all we do is professional services firms between 25 million and 100 million with 20% EBITDA margins, and we help them get tech enabled, scale their business development, and do M&A. If they got a playbook for that, then you're probably having a different type of conversation versus how do I implement your playbook, but still in a contextual way that makes sense for our firm.
What's one major thing that you wish that you knew when you were going into that environment as a executive within a private equity backed business that you're like, this is, if I knew this beforehand, life would have been a lot simpler?
That's a good question. And there's definitely more than one. But I would say probably the biggest learning that I had going in is because I was running the business pre-private equity and then running the business post-private equity in two different transactions, probably recognizing the importance of us agreeing on inorganic and how we were going to think about acquisitions and over what time frame. I think that was something that when I was CEO, we could have done faster and more thoughtful. And it wasn't that my sponsor wasn't supportive of that. I think I was still wedded to, it's going to be all organic because that's what I know, that's what we've done. little bit of chest pounding, then I should have really sat back and thought about value creation from a different perspective.
When you say this term value creation, it's an overused term in private equity. What's your take on value creation, and where might be a bit of a big topic, but where people should get started around even just considering how to look at what areas of value creation they should deploy in a business?
Yeah. So number one, that your business, you're creating value for shareholders. And at the end of your quote tenure, the business is worth, significantly more, and you're able to generate somewhere between, you know, 2 to 3.5 times a return on invested capital. I mean, that's the math answer, right? Relative to where do you begin? I mean, to me, as a growth guy growing up and building a go-to-market advisory firm, I don't think there's any faster path to value creation than sustainable growth, both organic and inorganic. That's very thoughtful, because you can take cost out and you can be clever with financial engineering, but eventually you got to figure out how to grow the top line. And most businesses now, right, there isn't going to be enough waste that you can just slash your way to great returns. So, and this isn't a math thing, talk to any, top tier private equity deal partner or founder with very notable names, and they would point to growth as a lever of value creation. I think the other thing is recognizing the team you have when you start with a private equity partner is not going to be the team you finish with. You're going to need people who understand what it looks like at the next milestone and know what that journey is. And so having a mix of people who've been there before versus those who can organically scale in their role is also very critical.
How did you find that transition, Matt? Because it's difficult for a lot of executives who, yes, like yourself, really, you've come up through into private equity with the business. You've then gone once, you've then gone twice. How have you found that transition of people? Because
Yeah.
whether it's, and I love the term, you're not going to finish with the same people you started. And everyone's like, well, that sounds ruthless. And I'm like, there's two answers to that. One is those people that joined you are not the same people as they were, as in the individual is not the same person because you've had to shift them out. But then secondly, that X person, whatever exec title, job title, whatever, has had such a transition between running a business that was 20 million to now running a business that's 150 million, is that they are a complete different person than they were with regards to capability. So it can mean the same people.
Yeah.
What's your take on being able to develop that shift, to be able to develop those people, but also be able to make those changes when needs be in what can be a very high end, very ruthless environment as perspective, but basically it's just that people are asking the very highest of businesses and people,
Yeah.
because we're not taking 30, 40 years to do what private equity is doing in, well, ideally 5, but sometimes takes 7.
Yeah. So I think there's a couple things. One is realizing that before you talk about who's going to take a role on your executive team, what does the function need to deliver? And very oftentimes, Alex, I'll see people talking about, well, Sarah should do the following. And I think I can move Bob into this role and he's good, versus going, okay, relative to how we think about customer success in our business now with 300 clients and X amount of ARR, if we hit our targets, we're going to have 1,100 clients. We're going to have this amount of ARR with multiple products. What does that leader look like who can run that size of an organization? And you think about the business objectively, right? Which is where private equity firms are great. They don't get wedded to people. They're very unemotional. Leaders often get emotional and they get tied to people, especially their people. Hey, he's my guy. I hired him, right? I know his family, etc. We, did all this stuff together, and you have a hard time going, man, I don't know if Bob can get there. So to me, it's understanding the role and the function and its importance in your value creation plan. And your top 3 executives should be tied to your top 3 levers that are going to drive value, because not every executive role is created the same in companies. If you're in a software company, you have to have a great product guy, you have to have a great revenue leader, and you got to have a great customer success retention person. Not saying that you don't need a great HR leader, but they're not going to be the difference maker if you stack your top 3 executives. It's a fact.
So if you have any, when do you advise your executives when they start to think this person's maybe not going to make it? At what point do you start to think, because what I tend to find is we tend to hold on to people for far too long.
Sure.
And that's both within our business, but also, private equity backed organizations. Even as a search firm, we do make that mistake, especially prevalent in recruitment. When do you start to go, we need to start thinking about what we're going to do here?
After the first, what I call the listening tour, which is that first quarter in the job, whether you were an insider and you got promoted as the first or second CEO, or you came from the outside, you're going to kind of size up customers, market. You'll get a real sense. Like, yeah, you did your diligence in the interview process, but you're going to really know. At that point, being able to sketch out and go, okay, I've seen and heard enough. I probably have 1 or 2 people I got to move on quickly, right? In the next 3 to 6 months. I probably got a couple people on my team that are wait and see, but I need to make some decisions with them probably months 9 to 15. And I probably have 1 or 2 spots that are identified as holes or maybe potential new roles in the exec team. But by the middle of year 2, you want to have your team in place and a team that can really help you scale and spend the back half of the hold period bringing the plan to life.
Perfect. Appreciate that. What are your influences, Matt? What do you read? What do you watch? What do you listen to that you would recommend that others check out?
Yeah, I mean, I'm not a big fiction guy, right? So right now I'm reading actually a lot of books on the second half of life and to having purpose and real meaning, which was part of the impetus of writing this book. So I'm a big fan of anything that Arthur Brooks puts out. I just read From Strength to Strength, one of the best books I've read. So that's one. I'm also big on gratitude journaling and I meditate every day. So I started doing that in the CEO seat because I think if you don't have time for yourself and you don't reflect on your thoughts, you spend all your time reacting and you don't have that piece. And then, number 3, I still love sports. I grew up playing hockey and that was my job out of school. So I find some time for a little American football and watch some golf. So
nice. And if anybody wishes to reach out, Matt, post this, how best do they get in touch, please?
Yeah, I think LinkedIn is easiest. Instead of telling you my email address, you just find me, Matt Sharrers, Sharrers. I'm on LinkedIn and I'm pretty easy to get in touch with.
Well, Matt, thank you very much for coming on to the Private Equity Podcast today, giving certainly a good insight for CEOs and other executives on how to transition from the business from founder-led, founder-owned into private equity-backed. And no doubt a lot for private equity firms to listen to as to the ownership they give and accountability they hold against their executive team. So thank you very much for coming on to the podcast.
Thanks, Alex. I appreciate you having me and keep up the great work.
And for all of our listeners out there, if you haven't already done so, please do subscribe to the Private Equity Podcast that comes out every single week. But till the next time, keep smashing it. And thank you very much for listening. Matt, that's great. Thank you very much.
Yeah, man. Thank you.